Guys, only when the tide goes out do you discover who's been swimming naked. This is a famous saying by Warren Buffett. So, what does this mean and how does it apply to the stock market and the crypto market today, starting with TerraUSD crashing? Let's start with the stock market. During the 2009 financial crisis, the Bernie Madoff Ponzi scheme was exposed. So, why was it exposed only after the stock market crashed? Well, because people needed to cash out of some of their investments or were worried that their stock investments would go lower. Only when they tried to cash out did they realize that Madoff was running a Ponzi scheme. In fact, many of the people who invested with him secretly believed that he was able to generate these steady returns by using insider trading related to his market-making firm. They really wanted to believe. This brings us to crypto today. So people want to believe so bad that one of the almost 20,000 cryptos out there will somehow make them rich from a small investment. And if that doesn't work, then they will at least pick up 20 or 30% or more a year by staking out their cash or crypto into some kind of liquidity pool. If it seems too good to be true, well, you know the rest. Well, it seems that the tide is going out, and not only is Bitcoin and Ethereum down about 25% in a week, but the so-called stablecoin TerraUSD is not so stable and fell about 25% today. Now, I don't know if TerraUSD will recover or if it is a Ponzi, but it sure could be the first crack in the dam that kills confidence in so-called stablecoins like Tether that are supposed to be backed by US dollars. If enough people lose confidence in stablecoins or crypto in general, that rush for the exit could bring a much bigger crash. Now, I don't claim to be an expert in crypto, but I looked a little bit into TerraUSD and these liquidity pools, and it seems to me that in all of these new revolutionary cryptos or ideas, their goal is to make it so complicated that nobody can understand it. Then they offer a high interest rate to get you to swap your real money for their made-up money. Now, before you say FUD and the US dollar is not backed by anything, let me just say that the US dollar is backed by US taxpayers and the US military that make sure it is accepted for trade in commodities worldwide. So the way that TerraUSD and the Luna coin work is that they're supposed to be interchangeable and create arbitrage opportunities to keep the TerraUSD at $1. What they don't say is what gives value to the Luna coin that you trade for TerraUSD. So I'm going to look at a simple example of these liquidity schemes, and when you think about it, it really sounds pretty ridiculous. So before we start, let's just take a look. Bitcoin is 30,800, down about 20% on the week and about 9% on the day. It's just before midnight on Monday night. And here, TerraUSD is 76 cents, down 23% today. Look at that chart. And this is supposed to be the coin that you use to arbitrage to buy and sell TerraUSD, Luna coin, which is down 53% today. So TerraUSD has only been around since like 2019 and had this dip to like, what's this, 85 cents once in 2020. But now we are way past that. Let's see what some of these people are saying about Terra. Here, things will be okay. Why people have so much FUD when they know crypto has ups and downs, but who holds on to it eventually survives. It will be okay. This is what happens when you back a stable coin with an unstable asset. So here is how these staking schemes work as I understand it. And you either put in your Bitcoin or your Ethereum or even dollars that you swap out for the other cryptos. So here are the investor side, and here are the crypto magicians that just make this crypto out of thin air with whatever new idea that they come up with. And this is the box you're supposed to put money into at some magical ratio that always goes up and down but stays stable or something. And here is the magic market making robot algorithm that figures out how much to charge when people want to buy the crypto and sell the crypto and return their cash or their Bitcoin or whatever. This thing, this friendly little robot, does all the transactions for you. So you don't even decide at what price to sell your crypto or your cash or whatever for these made up crypto coins. So the investor will use their money to either buy the crypto coin or put in their own Bitcoin or Ethereum or something like that, call it real money, put it in the box, and the crypto company will say, okay, yes, you put in your $100 bill, so to speak, and we'll put in our $100 bill, except that their $100 bill is monopoly money, and they could print as much of that as they want. And so to entice you to do this trade, to leave your real money in here, they give you interest rates, crazy interest rates, sometimes 10%, 20%, 30% or more every year, as long as you keep it in there. And so they're giving you this interest with also made up monopoly coins. Now, this interest entices other people to invest, especially when you become an evangelist for this certain coin, whatever it is. And so now all these people get in here and they add even more money to this liquidity market making box that this robot does all the trades for you and figures out where to buy and sell your money, basically. But what eventually happens is some or all of these so-called liquidity pools become rug pulls because there's all this $100 bill sitting in here, and the crypto guys add their $100 in monopoly money because they're giving it to these guys, right? And so, okay, you guys get this and we get this. And then what happens? All that's left is this monopoly money, these people holding monopoly money that they traded for $100 bills. And that is pretty much how it all ends in most of these, from what it seems to me. Now, there's different variations to this. This is a real simple example, but I'm not going to go look up all 19,000 different variations of all the different coins and all of that stuff. But I will tell you this. Ask yourself a question. Do you really understand how the liquidity pool works, or how the stable coin works, or what gives it its value, or even for that matter, how something like Bitcoin mining actually works? It is really, really complicated. And even if you spend a lot of hours looking into it, you still will probably be pretty confused. Now, I even watched some really good videos on how Bitcoin mining works. And in some of the comments, somebody said, I'm still confused, but at a higher level. And it seems that's the trick to all of these coins, is make it so confusing that people don't want to look stupid. It's kind of like the emperor's new clothes, where only smart people can see this new clothing. And so nobody wants to look stupid. So they all say, yeah, I understand it. Whatever, just, give me my 30% a year interest, or 50%, or give me my $1 million I'm going to make on Dogecoin or whatever. So guys, this is nothing new. And when the stock market really starts to fall and people are no longer buying the dip because they are down so much money, they get rid of the garbage investments first. That means when your blue chip safe stocks like Amazon, Google, and Facebook are down 30 or 40%, you say, what the hell was I thinking buying these Cathy Wood ARK stocks with no earnings that are down 80 or 90% already? And so while you are getting rid of that, you also start to question why you are invested in any of the 19,000 different cryptos, when even Bitcoin and Ethereum are dropping faster than the NASDAQ is. So when everybody rushes to the exit at the same time, the scams and the Ponzi's are exposed. So guys, we're in a different market environment right now, so don't think what you did before is going to work going forward. It is really changing quickly. And let me know in the comments below if you think TerraUSD is going to recover, or if you think this is kind of the beginning of the end for these stable coins and cryptos in general. I hope you liked this video, and I'll see you in the next one. Thanks for watching, guys.